Your bank account can be frozen before you finish reading this sentence, and in Argentina, that's exactly what happened overnight on December 1st, 2001, when $70 billion in deposits vanished behind locked doors. With CBDCs expanding right now, the same trap is being built around your money. Here's the exact blueprint to get out before it closes. Let's start with a question most people never ask themselves. What actually happens to your money when the bank closes its doors? Not metaphorically, literally. When regulators show up on a Friday night, hand the keys to the FDIC, and post a notice on the front door by morning. Most people assume that can't happen to them. They have FDIC insurance. They have a 401k. They have a savings account. They feel protected. Here's the reality. Over 1,788 U.S. banks currently have commercial real estate exposures greater than 300% of their total equity capital, and that number has been climbing every quarter. The FDIC has been tracking massive unrealized losses on securities portfolios across the entire banking system, and even after some improvement, those losses remain large enough to keep pressure on weaker balance sheets when funding costs stay elevated. Translation: a significant slice of the American banking system is already operating in stress mode, quietly, without headlines. Now let's talk about the three assets people think will protect them in a crisis, but won't. Asset number 1, cash in a savings account. Your savings account is not a vault. It is a promise. And promises break. The FDIC deposit insurance cap sits at $250,000, unchanged since 2010. And whether it's enough to prevent bank runs during times of stress is still actively debated in Congress. If you have anything above that threshold, or your bank gets resolved over a weekend before you can act, that money is not immediately yours. Asset number 2, your 401k. Most people believe a 401k is untouchable. It isn't frozen in a bank failure technically, but it is frozen in a different way. Stagflation, the toxic combination of stagnant growth, higher unemployment, and rising inflation, is what over 56% of surveyed bankers say is likely to hit the U.S. economy in 2026. In a stagflationary environment, your equity-heavy 401k doesn't just underperform. It can be gutted by a market correction at the exact moment you need liquidity most, and early withdrawal penalties trap you inside a burning building. Asset number 3, long-duration bonds. This one is the trap most investors never see coming. Many people piled into treasury bonds thinking they were buying safety, and for a brief moment in history, they were right. But when rates stay elevated and inflation stays stubborn, long-duration bonds lose value in real terms even while they're sitting in your account untouched. You feel safe. Your statement looks fine, and quietly, your purchasing power is being erased. Now, before we get to the blueprint, there is one more asset class that looks like a safe haven right now, but has a hidden vulnerability during a freeze scenario. We'll expose it in the survival blueprint. Stay with me. Here is what the people managing the world's largest pools of money are doing right now, and they're not broadcasting it. Central banks are not momentum traders. They are reserve managers responding to structural risk. And right now, they are buying gold at more than triple the pre-2022 pace, roughly 60 tons per month, pushing gold to overtake the euro as the world's second-largest reserve asset, behind only the US dollar. Read that again. Central banks have collectively decided that the euro, the currency of an entire continent, is less trustworthy as a reserve than a metal you can hold in your hand. Countries from China to Poland to Hungary are repatriating gold reserves and increasing allocations. With gold's defining feature reasserting itself, it carries no counterparty risk, and it cannot be frozen by a foreign government. That last part is critical. It cannot be frozen by a foreign government. These are not retail investors chasing a trend. These are the institutions that design the financial system, and they are quietly building an escape hatch outside of it. China has logged 12 straight months of physical gold accumulation, bringing its total reserves to 2,304 tons. And many analysts believe Beijing is deliberately underreporting its purchases as part of a broader effort to test the dollar's dominance. The National Bank of Poland is racing to hold 700 tons. South Korea just resumed gold investment for the first time since 2013. Malaysia made its first purchase in 7 years. A near majority, 95% of surveyed reserve banks said they plan to increase their physical gold holdings over the next 12 months. This is a coordinated global exodus from the same financial infrastructure that your savings account is built on. And here's what they know that they're not telling you. There is a specific economic trigger being built right now. A collision between tariff-driven inflation and political pressure on the Federal Reserve. That could accelerate this exodus into a full-scale crisis faster than anyone on mainstream media is admitting. We'll detail exactly what that trigger looks like at the end of this video. Now let's talk about what you can actually do. Not theory, concrete moves. Move 1. Physical gold, not paper gold. This distinction will determine whether you preserve your wealth or lose it in a freeze scenario. Physical gold has no issuer risk, no fund structure, and no reliance on market liquidity during periods of stress. And that distinction matters to investors who view gold less as a trade and more as insurance. Paper gold, ETFs, gold futures, gold certificates, is still inside the financial system. It can be halted, restructured, or margin called out from under you. When Argentina froze accounts in 2001, dollars sitting in domestic bank accounts became pesos overnight. Paper claims on assets that live inside the system carry the same vulnerability. Physical gold in your possession or in a private vault does not. Goldman Sachs analysts now project gold reaching $5,400 by end of 2026. While Union Bancaire Privy targets $5,200, but that price prediction isn't the point. The point is that physical gold is one of the only assets that remains yours when the system around it breaks. Move 2. Bitcoin as a secondary hard asset with conditions. Bitcoin is not a perfect safe haven. We saw that in February 2026, when the first U.S. bank failure of the year coincided with Bitcoin falling roughly 8% as investors rushed for the exits alongside gold and silver in a liquidity stress event. But here is what makes Bitcoin different from every other digital asset. It cannot be inflated, it does not require a bank, and in the absence of a total internet shutdown, it cannot be confiscated through a decree the way Argentina confiscated dollars. Self-custody, holding your own private keys, is the operative word. Bitcoin on an exchange is paper gold. Bitcoin in self-custody on a hardware wallet in your possession is something else entirely. Use it as a secondary position, not a primary one, and never ever store it on a platform you don't control. Move 3. Foreign-held hard assets and jurisdictional diversification. The most sophisticated move in the elite playbook isn't what you buy, it's where you hold it. Countries like Poland, Hungary, and China have physically repatriated gold reserves precisely to ensure they retain direct control regardless of geopolitical events. The same logic applies to your personal portfolio. A portion of your hard assets held in a politically stable non-dollar jurisdiction, whether that's Swiss-vaulted precious metals, real property abroad, or foreign brokerage accounts in sound money jurisdictions, creates a layer of protection that a domestic bank freeze simply cannot reach. This isn't about tax evasion or paranoia. It's about the same logic every major central bank on earth is already using. Spread your exposure. Reduce your single point of failure. Now, let's talk about the specific trigger that could make everything we've discussed go from preparation to emergency. Nearly 88% of bankers surveyed by American Banker identified continued tariff volatility as either definitely or probably happening in 2026. And the Federal Reserve's own governor publicly stated that rising import costs will push inflation higher while simultaneously crushing real income and consumer demand. That is the textbook definition of stagflation. And here's what makes the 2026 version uniquely dangerous. Close to a third of surveyed banking professionals said they lost significant faith in the Federal Reserve's competence and independence last year. At the same time, there is active political pressure to replace the current Fed chair with a figure seen as more hawkish, a move that created immediate market chaos when it was first reported, sending gold and silver into one of their sharpest single-day drops in decades as institutional investors recalibrated their entire rate outlook overnight. Think about what that means. A single piece of political news, not a bank failure, not a war, not a recession announcement, moved the entire precious metals market violently in a matter of hours. Now picture that same volatility inside a banking system where over 1/3 of U.S. banks carry dangerously high commercial real estate exposure, where deposit insurance hasn't been updated in 15 years, and where resolution regimes have quietly shifted from bailouts toward bail-ins, meaning that wholesale depositors can no longer assume they sit outside the loss-absorbing perimeter. Bail-ins, that is the word that should stop you cold. It means the next time a major bank needs rescuing, your uninsured deposits could be converted by law into equity in a failing institution. Not stolen, legally converted. Just like Argentina's dollar deposits were legally converted into devalued pesos. The infrastructure to do exactly what happened on December 1, 2001, at scale, digitally, overnight, already exists. The CBDC frameworks being piloted across Europe and Asia are not a future risk. They are a present architecture. Once that system is fully integrated with your account, the question of access to your own money will no longer be yours to answer. The window to act is not next year, it is not next quarter. The people who moved first in Argentina didn't do it when the crisis hit. They did it 6 months before, when the warning signs looked exactly like what you're reading right now. History doesn't announce itself, it just closes the bank. The 3 assets most people depend on, savings accounts, 401 kiloseconds, and long-duration bonds are not protection in a freeze. They are exposure. The blueprint to get out is specific, executable, and available to you today. Physical gold, self-custody Bitcoin, jurisdictional diversification, that is how you stop being a victim of a system that was never designed with your survival in mind. Subscribe to this channel, because the system won't warn you when it's about to lock you out, but this channel will.